Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So stocks are negative for the year. Everybody knows that. Bonds have had a rough year as well with rising interest rates. That's the first year since 1994 that this has happened. Let's take a look back and see what historically has occurred after that. Number two, Dow Jones Industrial Average as of last Friday met the record losing streak of 8 consecutive weeks, all the way back to 1923, the last time that happened. Finally broke that streak this week. And finally, I always like to remind people in the midst of the highest volatility sometimes, take a step back and let's take a look at the odds of stock market returns being positive over longer term periods to put it in perspective. All right, so you can see the year-to-date numbers up here. The past 50 years, there has only been one calendar year, 1994, where both the S&P 500 index and the Bloomberg U.S. Aggregate Bond Index were both negative for the calendar year. You can see so far this year, not quite mid-year yet, but we are on pace for a historically bad year for both stocks and bonds. Nothing like we've seen before. Now, let's take a look at in 1994, what exactly followed that year? Well, 1995 happened to be one of the great all-time years for that 60-40 portfolio with the S&P 500 up nearly 38% and the Bloomberg US Ag Bond Index up nearly 19%. That's 18.5%. Really strong performance from both asset classes during the following year. Only a sample size of one, I know, but sometimes you see these snapback rallies, especially on a quarterly percentage. We've already seen bonds when yields have risen up so fast, they started to take a little breather, and we started to see longer duration perform a little bit better here during the past couple of weeks. Now, the Dow Jones last Friday's close on May 20th finished down. That was the 8th consecutive negative week for the Dow Jones Industry Index. That has only happened one other time in history, all the way back to 1923. We can see at the top of the table here, at the top here on May 18th, 1923, also in May, coincidentally, we had the 8 losing streak. We see 1 month out was about flat. Actually, 1 year out was actually pretty negative. But if you open up that study a little bit and drop the bar down to 7 consecutive weeks, which again is very, very rare, only happening 6 times in history, all the way back to 1921. Last time it has happened was in 2001. When you average all those together, what's interesting is this whole concept of the rubber band being stretched, the market getting so oversold, sometimes it snaps back. You see on average 1 year out, nearly 14% return. That's almost double the normal anytime return for the S&P 500. Not 100% win rate, but sometimes when these markets get so oversold, we often do see a little bit of a reversion to the mean. And then finally, as I said, bear market territory, small caps down 30%. International markets have been lagging for months and months and months. Some of the weakness we've seen has actually started back in June of last year when we're talking about small and mid cap underperformance. So a lot of fear out there. But I think for longer term perspective and longer term investors, know your time frame is always what I say. And if you're a long-term investor, take a look at these probabilities for the S&P 500. Looking back historically, the percentage of time that the 1 year return, 5 year return, 10-year and 20-year return is positive. Historically, you can see 1 year out, 3 out of 4 years are positive. 5-year total return, almost 9 out of 10 years are positive, and 94% go all the way out to that 20-year return. If you have a long time frame, 20%. And one of the things I always say is if you're young, you should be actually rooting for bear markets and declines to give you opportunities to dollar cost average in with your periodic contribution. So again, know your time frame, and just remember, for longer term strategic investors, these types of probabilities for stock market returns, to try to remember and put the short term volatility in perspective for your portfolio. With that, I want to thank everyone for watching. The Merriam-Webster dictionary came out. They do this every year, but 455 new words and definitions. A couple stuck out to me. I got to admit, I have not kept up on the newest words and themes, but TBH, to be honest, I'm somewhat familiar with that, but I didn't know that dictionaries were using acronyms. That was a surprise to me. The Fluffernutter, never heard of it. And to be honest, I wasn't sure what that was, but it turns out it's actually a peanut butter and marshmallow sandwich on white bread. So basically a peanut butter and jelly. Substitute the marshmallow for the jelly, called a fluffernutter. Apparently that is the official definition. And finally, whataboutism, another one that stood out to me. Again, I think we're just combining words now and making up things and they become official, but apparently that's the history of the English language. So I think we just have to get used to it because I don't think it's changing anytime soon. With that said, I want to thank everyone for watching, and I'll see you next time.